You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back once again for the Advisor's Option, the program here on the old Options Insider Radio Network. For you, the busy asset manager out there, the financial advisor, maybe you're looking to learn a little bit more about these crazy options things. Maybe your clients are coming to you saying, hey, we want to utilize these in our accounts, and you have no idea where to start. Maybe you want to catch up on the latest and greatest in the world of options and derivatives. Either way, we got you covered here on the Advisor's Option. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the ever-engaging, at least we tend to think so, Options Insider Radio Network. Reminding you at the top of the show here, if you do like what you hear, this is really, in terms of advisors and options, this is really the only show of its kind. So if you do like what you hear, you want to share it with your fellow advisors. Maybe you're also a client. Maybe you want to know what your advisor should be bringing to the table. Either way, share it out there on your platform of choice. Give it some ratings, some reviews. It does help new people continue to discover the show. And then, of course, if you want more content, if you have more questions, I know a lot of you do, then our great pro Q&A sessions where you could pick the brains of some of the best minds in the world of options and derivatives are ready and waiting for you. Nearly 200 episodes already on that exclusive feed. More coming every week. TheOptionsInsider.com/pro is the place to go to sample all the wares that are available there. And let's see who's joining us on the old Advisor's Option program today. I'm pleased to be joined once again by my compatriot in all things Advisor's Option crime, Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services, a.k.a. the creator of Otto. Mr. Matt, welcome back to the show, sir.
Great to be known for the creator of Otto. with AI all in the news. We've been using AI for a number of years, at least machine learning and such. So it's all the rage now. Historic times, Mark. So it's great to be on, and can't wait to get to it.
These are indeed historic times. So let's not waste any more time. Let's get right to it. It's time to get the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to the buzz, the portion of the show where we break down all of the developments, the breaking news, the fun things in the world of options and derivatives that maybe you missed because, hey, we get it. You're busy out there calling and getting calls from your clients. These are crazy markets. If you're not spending most of your time doing that, you're doing something wrong. Luckily, we're here for you on the show. And as Matt alluded to, it is a bit of a historic episode, a historic time here in the world of options. Matt, you and I have been doing the show together for a while. And how long have we been talking about, can this options party continue, right? Can this juggernaut of options volume that was unleashed by the pandemic, can it continue? The answer so far for pretty much every month and indeed every year since 2020 has been yes. Of course, you saw last year, a historic year, over 10 billion contracts being cleared, just a ridiculous amount of volume. We saw some months now starting to threaten that 900, 910, 920, 930 million contract. And these are just absurd amounts of volume. So it seemed like maybe if we all try really hard, then maybe the options business as a whole could put up 1 billion with a B, 1 billion contracts in a single month. And lo and behold, March was that month, listeners. Since the last time we gathered here together on the show, the numbers are now official from our friends over there at OCC, the Options Clearing Corp. And man, what a month March was. Total volume 1.1. Not even, they didn't just barely make it over. 1.1 billion. They blew past it. 1.1 billion contracts. That's up 12.2% from an already banger year, an already banger March of 2022. So year on year, up 12.2%. Obviously, the first time we ever crossed a billion. So that's clearly going to be the busiest, most active month in the history of the options business, dating all the way back to the primordial ooze days of the SIBO. Just crazy numbers. ADV also blowing the doors off. ADV for March, of course, ADV stands for average daily volume, listeners. ADV, 46.3 million contracts. That's up 8.4% as well. Now, to give you just some frame of reference, you might say, okay, we've been threatening that for a while. What's the big deal? And the truth is, prior to the pandemic, we were just on another plane of existence when it came to volume. In fact, it was a pretty much record year in 2019, right coming into the beginning of the pandemic. And everyone was super excited to put up 4.9 billion contracts in the entire year. So you're talking not even 5 billion contracts in a year. And just before that, we were talking the whole industry was putting up 3.75 billion contracts. So the notion that we're going from putting up 3.5 not too long ago in an entire year to now 1.1 billion in a single month, it's a paradigm shift. However you view this product, even if you're only tangentially interested or maybe barely considering dipping your toes in, clearly everyone else and their mother and their cousins are doing so. Matt, I've kind of run out of superlatives here, but this is an epic month. You've been in the options business for quite some time. Maybe you thought we would see this one day. I don't know if you ever thought we would see it this soon, sir. What are your thoughts?
Yeah, you kind of have to get historic on it. So, I used to go into these banks, and some of the banks, smaller banks, regional banks, are you trading options? No, we're not trading that much. It's just, we get picked off by the market makers, and so we're not even going to play. And I have that now everybody is getting involved. The liquidity is so much greater. The technology is so much greater. The education and the access to data, and just the ability to get in the market with minimal slippage, do what you want to do. I think you have to be eating into, and first of all, there's just a lot of investment dollars out there. The Fed, as I've always said, still starting to expand their balance sheet back. But there's a lot of money sloshing around. People are getting more sophisticated. There's a lot of money you have to put to work, and how are you going to do it, especially in a situation where there's so much uncertainty, so much going on in the market. Options are helping people manufacture investment outcomes that more than just ETFs or indexes can do for them. So I think all of those factors are leading to this monumental increase in option usage, including, these DTEs, and, those filter through the entire market. Once you get people trading that, they have to, it creates some edge in other places, arbitrage companies, and it's just filtering through. So there's just so much going on. It begets other things going on. And I think that's what's happening, Mark.
Yeah, I was just perusing some of the data while you were talking, Matt. And yeah, just in 2017, the whole industry was super excited that total volume was about 4.2 billion contracts, up a paltry 3% from the year before. And that was a big deal, Matt. And now here we're talking 1.1 billion in a month, just 6 years later. I mean, this is crazy town. And, we immediately, of course, into the pandemic, we hit 7+ billion contracts and really never looked back from there. So these have just been a complete whirlwind ride we've all been on here collectively in the world of options out here. Listeners, just crazy times. Glad to see you're joining along with us here on this crazy whirlwind ride. Hopefully your clients are coming to you with questions about this stuff. Hopefully you're intrigued. I mean, all these numbers at the end of the day, it's hard to avoid this space. And now the elephant in the room, Matt, is, of course, what is driving this? And a lot of it was, of course, people talking about back in 2021, the flow of retail into single names. We've seen some of that mitigate. People have gone back to work. That's the other thing. People thought that was just people locked up at home, and that's why all this options volume was accreting. And once everyone went back to work and trading wasn't the only sport on TV and a sport you could do, there was other things to do in life. All of a sudden, these numbers would fall back to earth, and instead they just kept skyrocketing to the moon. And a lot of that, of course, coming in the last year with this 0-day explosion. So I wonder for you, Matt, how much of this 1.1 billion do you attribute to this just 0-day phenomenon?
Yeah, I mean, and also the retail, as you were alluding to, teach a man to fish, and they're still fishing. But then they've unleashed this zero DTE, and we get so many comments on it, and we're back testing zero DTEs, and there's videos on zero DTEs. I should also mention that March was a pretty good month from a volatility perspective. We popped up, the market came down quite a bit, popped up. So you kind of had, a pretty good range and some gaps. And so, it kind of had something for everybody. So, that was a good month. I have to believe that April's going to be a little less than March, but we'll see. But, these zero days, people are starting to hone in. I mean, when they're that new, people have to start figuring out what type of strategies that they're going to implement with these things. And when they're that new, I've made the case that that if they're that new, then people researching that don't have the big bucks behind them, it's a more of a level playing field. And so it's still new to market makers how they're going to mark things. Where they're going to put their markets. And by the way, one of the things that I think about zero DTE is, that it's such a net benefit for on so many levels. There's a lot of people wringing their hands that it's going to cause a crash. I think it's the opposite. I think it provides, a very good opportunity for these market makers to reduce a lot of their risk. Whereas, when you have people just trading certain, buying puts, selling calls all the time, that's a risky position. But when you come in and you have these zero DTEs, they're able to, hedge a lot of the kind of systematic risk that they might have from, banks needing to buy out of the money puts, for example. So the market makers are going to be short puts, but the zero DTEs allows them, and there's so much volume, it allows them to, buy in some of those that they need and, actually reduce a lot of the risk. So, I think there's a lot of trading going on in the zero DTEs because it does benefit a lot of people. Theta sellers, you have the theta right away. But it's also the SPX is now much more accessible. I've even dabbled quite a bit in the SPX now that, the premiums aren't that great. And you need to be, especially for retail, you need to be hedged. You need to be doing spreads. And then, it just isn't that much. The options aren't that huge. Obviously, as you go out, I do some time spreads and such. Those are much bigger options. But again, I think all of this zero DTE is good for the market. It's good from the ability to understand how much risk is in the day that you're in the hour that you're in a lot of ways. And that's what really, to me, coming from a finance background, wanting to go down to the floor to continue my finance research and thinking that it's the freest place to go in and trade and trade based on, if I'm smart enough, I can make money, but if not, I'm not. So, luckily I've been in the market since the early 90s. And, again, I think that this is just another progression, this zero DTE, in order to have options, which I thought were important back then. They're even more important now, there are very many uses, macro, micro, et cetera. So, yeah, I think that these zero DTEs are, having a major impact, from a volume standpoint and also a spillover standpoint. As these start trading more, you start to give more, information as to where the volatility is. And, that in turn leads to more volume. So I think we've identified the culprit, Mark.
Yeah. Well, looking at the numbers here from OCC, you can also see a few interesting clues here as well. For example, one of the highlights they point out, index options cleared volume up 67.7% year over year, Matt. So there you go. There's your smoking gun right there. Of course, the lion's share of 0-day contracts going up in the indexes, listeners. ETF options up about 33%, so no slouch there as well. And then even the futures getting a nice lift. Of course, futures, what does OCC clear on the futures front? It's pretty much VIX futures. So even VIX futures getting a nice little lift back in March. So March, kind of just a banger month across the board, and clearly a historic month for anyone who trades options. And, since we're talking so much about all this 0-day stuff, we were hinting it on the last show. We thought maybe we should do a deep dive into these things. I think we're going to do that now, listeners. It's time for a little Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101, the portion of the show where we break down some basic options concept or technique or strategy and explain how you could utilize it in your portfolios, or in this case, your clients' portfolios. And today we're going to talk about a product and what the big deal is, really, at the end of the day. Matt and I were just talking about this 0-day for now. What are we talking about? Well, in a nutshell, it's a pretty basic concept. It's a lot of people coming in and buying or selling, essentially initiating options trades in contracts that are going out that day. So that's why the 0-day phenomenon, there's no other days to it. You're getting it all done in a single trading day. Come hell or high water, that option is going the way of the dodo at the end of the day. So It's an interesting phenomenon. It's not a new phenomenon. This has existed for a long time. Obviously, there has been expiration in the options world since the launch of options. Options are not a permanent instrument. They have to expire. So if you came in on the last day of an options life back in the old days on the SIBO, for example, and Matt and I were market makers down there, expiration day was always a pretty crazy day. That one day of the month, some folks would just avoid it completely. Other folks would show up just for that day. They loved the ability to trade options, buy them below their theoretical value, sell them above. You could get some interesting trades off if you were pretty deft and pretty quick. But also it was a time when gamma would explode and theta would explode. You'd see a lot of people riding a lot of short gamma all the way into the close, and they were usually popping a lot of tums and sweating with every tick of the stock. So it was always a pretty crazy day. I would personally like to close out a lot of positions so you didn't have a lot of net residual positions that could catch you on a day like that. A lot of pros tended to try to avoid it for the most part, which is why it's so funny to me now to see fast forward to 2023 and it's become all the rage, and large funds are clearly trading it. Little retail traders are everyone is trading and diving in to this 0-day phenomenon. But why now? Why is this happening now? Well, weekly options have been around for a while as well. And when they added the weekly options, obviously they upped the expiration game. Now, all of a sudden, you went from 1 expiration a month to 4 expirations a month. So that made the notion of Expiration Friday, this once a month signature event, kind of a little bit quaint, a little bit dated, kind of went the way of the dodo. Instead, we had 4. And then they started adding more expirations. They said, you know what? 1 expiration a week is not enough, particularly in the large index products like the SPX. They started adding other expirations. And by this time a year ago, by April of last year, SPX and most of the major indexes had gotten down to a pretty regular expiration schedule where they had a Monday expiring weekly, they had a Wednesday expiring weekly, and they had your traditional weekly that expires on Friday. So if you wanted your choice of expirations, you had a lot of choices. You had Monday, you had Wednesday, you had Friday, on top of your traditional monthlies and everything else they have out there in these index products. SIBO, in their infinite wisdom, pretty much exactly a year ago, April 13th, so a year and 5 days ago, they came out and said, you know what? We're going to just finish up the cycle. We're going to add 2 more. We're going to add a Tuesday expiration and a Thursday expiration to our SPX weekly. And you might say, big deal. That's what a lot of people said when this was announced. Big deal. This has been done. We already have a bunch of weekly expiring contracts. It's not that big of a deal to add 2 more. You're just completing the cycle. Okay, big deal. Not that crazy of a thing. But lo and behold, it was a very crazy thing. Looking at the numbers here, SIBO reporting at the end of 2021, so the last full year before they had everyday weekly expiring contracts now, there were a total of 247 million SPX weeklies traded in 2021. That accounted for 72% of total SPX options volume. They don't break down 0-day then because it wasn't really a thing then. They don't break it out separately, but obviously the weeklies are pretty active. And then fast forward to last year now that they launched these things in April, we start seeing an uptick in interest in them. All of a sudden we start seeing on our network, people are hitting us up. What about this 0-day stuff? And I was like, what are you talking about? It didn't even occur to me at first that this is what they meant because it seemed like such a normal announcement to me. And yet people really responded en masse. By the end of the year, SIBO, the ADV for SPX options with 0 days to expiry increased 83% throughout 2022 and comprised nearly half, 43% of overall SPX volume in 2022. So really in the span of half a year, a little more, these things went from kicking off to fundamentally changing the way large index options are traded here in the US. Right now, if you go pull up SPX, first off, the volume's going to be just blowing the doors off. It used to be, if you saw SPX doing 1.5, maybe 2 million contracts, that was a really busy day. The ADV is pretty much 3 million contracts now. And if you pull up SPX right now, I guarantee you, of the top 20 contracts that are trading in SPX today, all of them will be 0-day. There will be this stuff. There will be expiring today contracts. If you expand it to the top 40, 35 of them probably will be expiring today. So it has changed the game in a lot of fundamental ways. Obviously, we've seen CME follow suit. Other indexes offer it as well. So If you're out there trading large index options, this weekly 0-day explosion has really changed the game. Matt, you were talking about how you've kind of gotten lured down to the dark side of 0-day as well. I'm curious, what is it that really has lured you to this dark side of 0-day? Are you also seeing a massive influx of inquiries from your clients and end users over there at ORATS? And what do they think of these things? What are they using them for?
Well, first of all, I think one of the biggest things that happened a year and 5 days ago was now you have every day. So you have the ability to make a business out of it. Banks could set a desk up around it. It's something that you could do every single day and do the same thing. And we'll be able to trade a specific strategy and make it consistent. So I think that is, it seemed like a small thing when they added Tuesdays and Thursdays, but like I said, now you could build a business. You could say, okay, this is what I'm doing every day of my trading life, and this is what companies have done. So I think that was, a much bigger occurrence than people give credit to it before. Now you can start to do it all the time. So now what you're seeing is people coming in consistently. They're coming in every day. They're doing strategies based on either signals or they're just they're waiting till their time that they could get in. They have certain risk reward that they want to accomplish, but they have you're able to now build a business and build a trading a trading desk around how these 0 DTEs behave. And you can see how you're going to be doing very quickly. It's not like you're holding these a long time. So that's part of the allure is, A, there's not a lot of risk. You're not holding it overnight. And B, you get to see how you're doing. And C, there's a ton of liquidity. So there's a lot going on there. And like I talked before, you could really manage your risk, and you could make some money doing this, and you could also lose some money. But you could also test these situations. Obviously ORATS is a big backtesting firm, but when you're using 0 DTEs, you're seeing what's happening during the day. So backtesting is still important. We still do a lot of backtests on the 0 DTEs, but it's not nearly as important because you can see and start to, you only have a year of everyday expiration, so you don't have that far to go back. So you can kind of figure out, what's your risk appetite, what's your win-loss, and all the other statistics that you might look at in order to figure out, what's a good risk-adjusted returns for these things. So, I think it presents, a blank slate for people to start to get these strategies going. There's a lot of theta. Obviously, there's a lot of gamma too, but also you're most likely protected, especially if you're retail, because you almost have to be, you almost have to be hedged. Otherwise every one lot of short straddle is $80,000 of maintenance required to have, so people aren't going to do that, but there's plenty of small options not too far out that you could buy in order to reduce that outlay that you need to put up against the strategies that you're doing. So, for those reasons, it's really caught on, and, for the theta reasons, people come in, and they have, and there's a lot more technology out there to just grab their dollar of profit and get out, or if they don't get it, roll out to the next day. There's a lot of ways that you can trade, and there's more technology, including ours, that have alerts, and there's also algos out there to help you get in and get out at specific times. So I think all that together, Mark, is presenting ways that people could develop on a consistent basis, and they'll put the time in now that it's every day, and go out and get a trading strategy, and hopefully it's a winning trading strategy, Mark.
Looking at all the 0-day data you've crunched now over there and talking to your clients and seeing what they're using out there, what would you say is the number one go-to 0-day strategy right now?
Yeah, I mean, it's selling a put spread or a call spread. It's just a vertical that they're selling. And as far as things that people are considering, they look at, which way is the market going, open or close. We're having trending markets recently. It seems like it's up in the morning. It's going that way. So they're doing things like that. They're doing things like they'll tranche out the market. They'll do a specific strategy in the first hour. 2-hour segment. If you break that 6.5 hours, it's something like 2 hours and 10 minutes. So they're tranching that out in thirds in some cases, and maybe every hour in other cases, in trading specific strategies based on those. But a lot of either verticals where they'll trade one side, or they'll if it goes against them, then they'll put the other side on. Move the challenge side, for example. If you have a short put spread and a short call spread, the market's going down, your challenge side is the put spread. So they might roll that out. They might not, or they might even roll it to the next day. Or you could roll the unchallenged side, which in that case would be the call spread, to try to get more premium to cover if it's going against you. There are strategies, that are somewhat basic, like a vertical, and then they add on, the other side, making it an iron condor, and then they'll also add on adjustments and when to adjust. So all these things and what to do as far as timing goes. They might put in the last 15 minutes, they might do an iron butterfly and try to get that last few minutes of, where it pins or comes close to closing at your short strikes. We've seen a lot of different strategies around that. Our back testing shows that people are really getting clever with the type of strategies that they are testing. So those are a lot of things that we've seen, Mark.
The other question we're receiving quite a bit now is, okay, indexes, that's all well and good, but I trade Apple options or Tesla or whatever single name option. Pick your poison out there, listeners. Do we have those on those names? Will we see those this year? And the answer is kind of yes and probably no. First off, single name 0-day stuff. There's a lot of complications there. The OCC, I've asked them about this before. I'm heading down to the options industry conference next week. So I plan to maybe put this to them again to get an updated response on this. But their response in the past has been, well, there are a lot of complications for single name equity options like your Teslas and your Apples and your Facebooks and all that fun, listeners. They expire into stock, unlike most of these indexes, which are cash settled. So they expire into cash. It's easier to do those on a 0-day basis. You don't have stock flying fast and furious. You also don't have the corporate actions in indexes that you do in single names, takeovers, earnings, all that fun that tends to gum up the works from a clearing and settlement perspective. So OCC has maintained that they are not that interested in that and don't want to go down that road anytime soon. I think the options volume is clearly speaking another tale. They want it. And it is possible, listeners. You can trade 0-day options. I mentioned we have weeklies on most of the big names. So if you come in every Friday morning on a lot of the big liquid single name equity options, you are effectively trading a 0-day if you're trading a Friday expiring option for that same day. And a lot of people are doing that. Look at last month. Last month was an explosive historic month. We saw a lot of financial names put up a lot of paper, including Bank of America. Bank of America did over 1 million contracts when all that contagion fear news was hitting the tape. And it was on an expiration Friday, listeners. And the majority of that paper was all 0-day paper. So you can do it. It can be done. It can be done for size. It can be done under very stressful conditions. So the proof is in the pudding. It can be done. Talking to people behind the scenes, I don't think, unfortunately, we're going to see a lot of new issuances of 0-day Apples and Teslas. In fact, some people have hinted we may need cash settled equity options first. So we have to create an entirely new product category, Matt, before we can launch this new product category. So that sounds like a whole heck of a lot of extra work that I don't think the industry wants to do. What are your thoughts, Matt, on the existence, what we have right now for 0-day single names? And then also, do you think we'll see official 0-day single names coming anytime soon?
Well, I think that, I've talked to the same people at the OCC, and it just sounds like such a headache, especially if there's a corporate action split, dividend, something like that. It just, expirations every day just gets, it just creates such a headache. I see so many people just not liking getting the stock assigned to them. So, something, I think needs to be done along those lines. Is it cash settled? Is there something that you could do, to not get assigned the stock? But until we see something like a cash settled, individual name, I don't think we're going to see it, everyday expiration or the same uptake as we're seeing in the SPX. So those are a couple of my thoughts on that, Mark.
So there you go, listeners. A bit of an overview of what the heck this 0-day phenomenon is. You probably have been hearing quite a bit about, and also how it's contributing to these explosive historic months and indeed years that we're seeing out there now. If this trend continues, if these 0 days continue to grow, if we continue to see new products added to this 0-day tidal wave out there, then who knows? Who knows when the 2 billion contract month will happen? But that's a long way to go. But still, crazier things have happened out there, listeners. We are in unprecedented air right now in the world of options. So hopefully that's a good overview for you. If you have questions, if you're still a little bit uncertain about what we're talking about when you see this 0-day or often abbreviated 0 DTE, hit us up, listeners. You know where to find us at Options on most of the major social media platforms. Questions at theoptionsinsider.com also works. If you're one of our pro listeners, of course, you can hit us up in the live as well. And we will endeavor to get you answered here on this show as we keep on rolling. We got so excited with the historic volume and all the madness of 0 DTE. We haven't even gotten to some of our other segments. So now it's time, listeners, for the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everyone, welcome to the P&L statement, the segment born of the pandemic, where we started seeing so many just unprecedented things happening in the market on a weekly, let alone monthly basis, that we thought, we needed to spend some time on every show discussing what the heck just happened. And now it is our segment. It is the P&L statement. Mr. Matt, you've been saying for a while you weren't really feeling this rally out there in the broad equities. You were talking also about earnings season, which we'll get to in a bit in our earnings volatility report segment. So we just kicked that off this week. So some new data coming hot and heavy there as well. It seems like since the last time you and I talked, Matt, we've effectively been glued around that 4,100 level in the S&P. What are your thoughts out there as the S&P has kind of been glued and vol has mostly come in?
Yeah, I think I'm watching the same show that a lot of other people are seeing. The valuations just aren't there. The PE earnings. My feeling is overall this market is very much overvalued. I think a lot of people think that way, however. But you still have our signals are still pretty bullish, and I've talked about this on the show. So it presents a conundrum, Like, for example, I think eventually S&P earnings are going to go down to $200, per S&P unit. So that, if you get down to a reasonable PE ratio, right now we're at 19, but during recessions, which I expect, I think that you might get to a PE ratio of 15. Well, 15 times 200, that's a $3,000 SPX. So that's much lower, obviously, than we are now. But that's where I think fair value is, and we're way up. Much higher PE ratio for what the earnings are going to show. After rising rates, like we've seen, earnings usually come down precipitously, and they have been, but they haven't really been priced into the market. So I think that there's but still, it's just pretty. mundane out there, and there are a lot of people short, so the market's still just floating. It's just, all these people that are short, it's very difficult on them, obviously. The market could stay irrational longer than you could say solvent. So I've been trying to put on positions, for a strong market from a short-term technical perspective, from a lot of our volatility signals that we're seeing, for example, falling implied volatility and kind of trending down. We look at contango. Contango is up. That means, of course, the front months is lower than the back months. That's pretty healthy for a market. We look at these forward relationships. Those are pretty healthy. So everything looks pretty good. So everything's pushing the market up. The fact that everyone's short, the fact that we have a lot of short-term volatility signals. So it seems like there's someone underneath pushing the market up. There's a ceiling up there. It's not getting quite past it. But when that push goes, I think it's going to come down quite a bit. So how do you trade that? So my strategy has been, you have the puts way out of the money, which is going to cost you. And so long-term, way out of the money puts, and sometimes even with these calendars, these put calendar, so long put calendar where where the market's trading 420, you might be in the 360s or something like that. Longer term, like 400 days on the long. And so you're paying a few bucks for those. There's the theta is negligible because you have your short front. And there's the Vega, who cares? The Vega, volatility is so low right now. So, you could live with that for a while, but you're short, those are short delta. So then you need to, I think, offset that because, you don't know what this market's going to do. So I'm selling some, tighter spreads, 18 days, 22 days in that range. So you could get some deltas, get some theta coming in. And if the market rallies, then you just kind of roll those. If it rallies too much, then you just kind of sit there and, have slight negative deltas there. I'm even buying some just trash calls. I know it's hard for you to believe, Mark, but, 10-cent options are doubling and tripling in these rallies. So I have some of those, so you're protecting against it, just in case it blows off. It could get a squeeze. So many people are short. So those are the types of things. I'm not spending too much money. I'm not risking too much of my short put spreads. And I got, quite a few puts way, way below. So when this thing cracks, I'll be making, a ton of money, but I'm giving them a little bit, here and there. And then, you just have to survive. So that's how I'm looking at the market right now, Mark.
Fighting to pay for your puts day to day. It's an old game, Mr. Matt, but it can be a good one out there. And while you were talking, Matt, I did look up the day I was referring to back in Bank of America, going back really quickly to our single name conversation. It was March 10th, and Bank of America put up 1.07 million contracts. Looking at the top 5 right now, of the top 5 contracts, which account for about 300,000 contracts right there, 4 of the top 5 were all expiring that same day. So you're talking about 250,000 contracts right there, just in 0 days. So it can be done, Mr. Matt. There are ways to put up a lot of 0-day single name paper. Heck, we used to do it all the time back when we had expiration. Sometimes earnings will come out the same day as expiration. I remember that back in my Intel days on the SIBO and others. We'd see a lot of crazy things like that. So it can be done. It's not exactly new. Whether OCC wants to make it a regular thing, I guess, is another debate for another day, and one I probably will have next week down at the Options Industry Conference. But fascinating stuff as we keep on rolling, listeners. Speaking of fascinating stuff, a big driver of what's going on in the market right now, and the thing a lot of people have their eyes on when they're not busy watching the Fed, is, of course, earnings season. It is just kicking off as we speak. Luckily for you, we got a whole segment all about it. It's called the Earnings Volatility Report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everybody, welcome to the Earnings Volatility Report, the portion of the show where we do just that. We break down how the season is unfolding, and it is a brand new, it's always exciting, listeners. There's always a crackle of electricity in the air when earnings season commences because it's a whirlwind of opportunity. Will we blow the doors off? Will it be a horrible cycle? Who knows? But you know what? Luckily for you, we're here to crunch the data for you. All these reports we're going to talk about here, listeners, the earnings move results, the earnings season, and the earnings trades reports even. You can find all of those for yourselves, theoptionsinsider.com. Click on the options news and articles tab. You could go down a rabbit hole there. We always tweet them out on our handle at options on Twitter as well. So you can find a lot of interesting things. Matt, the season has only just begun, so we are still very much in the early blush, the early bloom of earnings season. But you guys are crunching the numbers over there at Oretz all the time. What are you seeing in this beginning of the early season? And of course, any final thoughts you may have on the season we just wrapped and closed the book on, sir?
Well, I think the season that wrapped, we did see what we predicted finally, that earnings is becoming much more important, especially guidance. And again, I think that this kind of all ties into my overall look at the market, where I think that a lot of these companies are going to be guiding lower. Rising rates, slowing economy. It's difficult out there. So I think we're going to see upcoming this season, and we kind of saw it last season, where the guidance was really what was driving some of the moves. And, you did have a profitable owning of straddles around earnings last season. So this particular earnings season actually started off a little slow. It's a little quiet out there. Our earnings report, there's so few that's a little squirrely, but, yesterday, or before the close, I should say today, Bank of America that you mentioned, just barely moved 1.2%. They're expecting 4.5. BK, moved 2.3%. They're expecting 4.8. So a lot of these were losers. Johnny John moved about expected. Goldman moved about expected. So those are the four big ones, this morning. It just, like, the volatility this low, it tends to bring down the expectations out there. But I do believe as this heats up, I think earnings is going to drive some market volatility in the upcoming weeks. We're starting to see some of these implied straddle moves, fairly larger than what's been in the past. So, it's early. Last season was a banger, and but I think this season's going to have quite a bit to show as well. I think eventually, it might provide some impetus for this, the market to move off of, potentially lower. Who knows? You might even get a short squeeze. So I think it's a lot of things are going to be coming out of this earnings season, Mark, where we're seeing either better than expected, which I doubt, or worse than expected and poor guidance, and that's going to affect the market.
All right, we are coming up against it, but I want to make sure we squeeze some of our listeners on too. So let's dive into real quick office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours, your segment. I mean, the whole show is your show at the end of the day, but this segment is where you folks get to reach out directly, get to send us your questions, your comments. We also get to pick your brains on some fun questions of the week. Right now, Matt, our question of the week for our audience is a very straightforward one, but also an intriguing one given what's going on in the broad markets right now. We asked you very simply, which option strategies are you using most frequently in your portfolio right now? Of course, it's a Twitter poll, so we can only put out 4 broad categories, listeners. So if you don't see your favorite, you can always send it in. We have some interesting write-ins. But the official categories are the short put or covered call, or the long call or long put, or your vertical or diagonal or time spread. We're kind of lumping them all together there. Or our final category is the butterfly or the spreads with wings category. Mr. Matt, what is your choice out there? I have a feeling I know which way you're going. You kind of just said it, but if you have a different answer, have at it. And then B, which way do you think our audience is going?
Yeah, I mean, I'm in the vertical, diagonal, time spread. Those were all my favorites. And I would hope that the poll goes that way. I think there's a lot of people selling puts and cover calls, so that might get it. But if it's your audience, smart audience, I think it's more verticals and diagonals and time spreads.
It's been pretty evenly split since launch, which is kind of interesting and shows what kind of interesting market we have, Matt. Right now, it's tied between short puts and covered calls, and then long calls and long puts with 28.9% each. That's eerily precise out there. And then 23.7% for verticals or diagonals or time spreads. And then bringing up the rear, 18.4% for flies or spreads with wings. At options, the place to go. You got the rest of this week to make your voice heard out there, listeners. Well, let's keep going with some of our questions. We've got so many here. I feel badly for LTAC. He's been waiting for a while. So let's go out to LTAC first. He says, on earlier episodes of the advisor's option, the host referred to collars as the, quote, holy grail for financial advisors. Yes, guilty as charged. That was me, LTAC. He goes on to say, but you've also referred to zero-cost collars as being suboptimal positions on your program. I'm a bit confused by this. Is there a distinction that I'm missing? Thank you very much for taking the time to read this question, and I hope you're able to answer it on the program. I'm sure many asset managers would benefit from your input on collars since it is such a popular strategy. Well, yes, LTAC, I have called it that in the past. It combines many of the elements that your traditional long equity asset manager or advisor wants, right? Their client comes to them. They have some stock positions. They want to trade options usually around or against those stock positions. What does the collar, I should say, combine? It combines a covered call, which is, of course, a great income generating position that a lot of advisors love. And it also provides protection, which a lot of advisors want but don't really want to pay for. Hence your question about the zero cost collars. Zero cost collars, listeners, are usually done in a single expiration month, and they're lined up so that the premium you're paying for that puts lines up with the amount of premium you are collecting for the call. Now, if you know anything about equity options, listeners, you know that there's always going to be a volatility premium to the puts in most names you're trading out there and a discount to the calls. So just lining those two things up to make them equivalent, you're going to arrive at some suboptimal strikes. You're probably not going to buy the put you really want. You're probably not going to sell the call you really want. So that's one of the first reasons why I call those zero cost suboptimal. If you're doing everything at the end of the day for the purposes of zero net outlay, you're going to make things suboptimal at the end of the day. Also, we've had a lot of studies, and I want to get Matt's thoughts on this as well, because he's always crunching back tests on this. We've had a lot of studies, including our friends over there at OCC, did a lot of studies, and OIC did a lot of studies on collars across a wide variety of assets. And they found things that are pretty much common sense if you know a lot about options, which is you have two components to a collar. You have a long premium position and a short premium position. They found if you mess with those expirations a little bit, you push the longer premium, aka the put, a little bit farther out in time. In their data, they found somewhere around 6 months. But the last time they ran that, weeklies weren't as big of a deal. So I wouldn't mind seeing some updated data on that. I have to wonder maybe if that 6 month time frame would be a little bit different now. But they came down on 6 months being optimal for the put. That's the best sweet spot between you're not paying too much for time you don't need, and also you're not being impacted too adversely from time decay, and then also concentrating your premium selling on the nearer date, which in that time frame was the front month. Now we have weekly. So you could theoretically buy a 6 month put and write weekly calls against it all the way out for 6 months. And the theory behind that is you're going to maximize decay on both sides of that trade. And at the end of that, you have a setup where hopefully you've collected a lot more in premium than you've paid for that put. And also by making it shorter dated on the calls, it gives you a chance to roll and adjust your strikes a little bit. So there's a lot more to it than that. So that's the way I prefer to set up collars, LTAC, pushing out that put a little bit and pushing that covered call, the short premium part, close to expiration as possible. Hey, now we have 0 days. So maybe 0 day is the answer for all of this. Matt, I know you're familiar with the OIC studies they did. Those are kind of getting a little long in the tooth now. I think they're at least 5 years old, if not older. So I'm curious for you. You're running back tests all the time. What are your thoughts, first off, on zero cost collars? And then B, what to you is the optimal collar structure, sir?
Well, I think we agree on a lot of the points. One is, we test things individually, meaning we test the short calls on their own, long puts on their own. And I agree. If you're trying to get right at zero, you're not going to be able to get the what we consider the best calls or the best puts for a particular stock. So that's the first thing. The second thing is, even just selling a call and buying a put is, not always the optimal thing. I talked about, the strategy for where the market is right now in a falling vol environment, what to do. So there are definitely, and we backtest a lot of this. We backtest what are the best strategies in certain environments. So, a lot of times there's just not enough premium in the calls to sell. So what do you do then? I mean, in my book right now, we're selling some at the money put spreads to get generate some income, especially when the market looks good. We're above the 200-day moving average. The volatility is falling. That might be that might be a way to, get some premium in. And then the puts themselves, is it best to buy the put? And where should that be? The most expensive puts are, seen in our back testing is 30 and 40 deltas 30 days out. I mean, you're going to pay like 5% and more, especially a lot of these single names. So what do? You could do a diagonal where sometimes those are the worst. So you might sell those and buy two, longer dated, way out of the money ones. So there's a lot of other things to do other than just collars. And obviously collars are understandable. A zero cost collar is understandable what your outlay is going to be, how much you could lose. But, from a perspective of what is the best strategy that's going to take advantage of where the market is, meaning is it high volatility, low volatility, is it skewed such that the calls are much lower than the puts, like it is now, that's going to affect, some of the things that you're doing. But, if you're an investor, you own stock to get these long-term returns. And a lot of times the long-term returns, if you read some of these studies, it's what stocks do in a couple of days. They don't just go up slow, they'll go massively. And if you miss a couple of the days, your overall returns are negative in some of these cases. So that's the problem about being short a call, a naked call. And you could sell the call spreads that would save you in those times. But, if you're going to be giving those away, that's really going to hurt your overall returns that you're going to enjoy from owning a stock. So, I think it's a lot more nuanced. It is easy. I understand for advisors that it's more difficult to explain, some of these other things. But, a short call spread, might save these investors. Long put spread or a diagonal might be a better way to spend your money on the protection. If it goes down so much, that might be where they want the short put anyway. So I think there's a lot more to think about rather than just a zero cost collar mark.
Yeah, the zero cost collar really only has simplicity working for it. Everything else is kind of working against it. Since we're coming up against it, but since we're talking about collars, we'll get out of here on this question for this episode, listeners. This one comes from Splitsville. It's along the same lines, at least from the collar perspective. Splitsville, I like the handle. Maybe he's a bowler. He wants to know, why is a long put or covered call called a collar while a short put long call is a risk reversal? Never understood that one. Yeah, if you start digging too deeply, Splitsville, into the origins of options terminology, you will go mad. Iron Condor, all these things. These names are, for the most part, ridiculous. You can think of it, though, in a couple of easy ways. The collar is usually done against a long equity, long underlying position, like we were just talking about, selling a covered call, buying a put. So if you think about that from that perspective, you're kind of collaring what your returns are. Right? You capped yourself to the upside, as Matt was saying. You've also limited your downside risk. So you kind of collared yourself in a fairly narrow range. So that one makes some intuitive sense. The bullish risk reversal, of course, selling the put and buying the call, the flip side of the collar, We used to think about that back on the market making days as a way to reverse your risk on the skew. We thought about skew a lot. And so if you wanted to, maybe you were too heavy on the put wing and not heavy enough on the call wing, you wanted to even things out, you wanted to reverse your risk a little bit, you could do that by selling the put and buying the call. So that was the use case that I came around. I kind of called them both really risk reversals. It wasn't until really I left the trading world and I came out here and more started engaging with retail and advisors and others who started using collars. That was never a term we used on the trading floor because it wasn't the use case. It wasn't the outlook that we had for it. Mr. Matt, anything you want to add here on the origins of these very bizarre terms?
Yeah, I mean, that was fun being on the floor and hearing some of these names, the jelly rolls and all this stuff. But if you think of collar, you think of you're collaring around stock. So you collar, there's going to be stock involved. Now, if there's no stock involved, then you're thinking, and just think of a risk reversal as almost long stock. It's just reversing into options rather than giving you a similar payout picture. So that's just the way I think about it, Mark.
Well, Mr. Matt, you packed a lot of living into this episode today. That music means we are done. But before we go, if folks are intrigued, they want to see what you and Otto and the rest of the team have up your sleeves over there at ORATS, where should they go? What should they do?
Yeah, I mean, it's going to be fast and furious now, Mark. We're sprinting towards year-end. We want to have the best research platform, broker agnostic out there.
Are we sprinting towards year-end already? You're scaring me. Is it already sprinting towards year-end?
I know. But, when you're in software development, people will understand out there in that crazy world. But, we're launching things like, we're tying into these various brokers, Tradier, TD Ameritrade, TradeStation. So it's really fun. You can click right from our platform, from our option scanners, options chain, trade builders, stock scanners, and send orders over. We have, good risk. We can bring in your positions. We show where your profit attribution is. So that's all coming. We're building out our backtester, whereas before you had to run backtest. Now we're coming up with a way that we're going to run 1 billion backtests, Mark. So you'll be able just to, instead of running them, you'll be able just to filter through, answer a few questions, and the best ways to trade certain things will come through. So we're super excited for all that. A ton coming on orats.com. If you haven't tried our new dashboard, you should get on it. It's a great tool. I love it for trading, scanning, for seeing risk, for trading right through. It's a nice product, very clear. We try to make it easy, but also powerful. So that's what we got going, Mark.
There you go. If you want to see it all for yourselves, listeners, only one place to go, orats.com, ORATS.com is the place to go to kick the tires and light the fires. If you want to see the early results of that collar study and everything else I was talking about on the data side, Options Industry Council, the only place to go, optionseducation.org. They have all that data for you there and a whole bunch more. That's going to do it for us on the Advisors Option today. Also going to do it for us today on the live side on the network. Back again tomorrow with a triple header. We've got a double dose of Options Boot Camp as well as a pro Q&A with our buddy Mr. Overby, the options guy himself. Thursday, of course, Thursday, This Week in Futures Options, as well as episode 2 of the Option Block. Friday, Volatility Views, and of course, Options Oddities coming out after that. Then next week, I'm heading down to the Options Industry Conference, so it should be an interesting time. I'll see what kind of news I could ferret out for you folks and all the question you're asking us about things like 0 day and everything else that is very important to you. And then, of course, we'll talk about it all on the next episode of the Advisor's Option. Stay safe out there, everybody.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.